For many years, people have been putting their uninvested cash in high-yield savings accounts or certificate of deposits. High-yield savings accounts offer customers a specific interest rate on their cash, and depending on which bank you have an account with, they might charge a fee depending on the set rate. This money can be taken in and out at any given time, and it typically pays interest monthly to allow compound interest. CDs are similar to high-yield savings accounts, but instead of being able to freely access your money whenever you want, it's typically locked up for a set time. These may offer higher rates depending on the time frame and the current economic state of the country. These rates are typically correlated with the federal funds rate, which is set by the Federal Open Market Committee. Now, the common complaint with these accounts is the rate they offer. When inflation is high, these interest rates are higher as well and allow account holders to earn more money. And then when inflation is low, it becomes the opposite. Some people argue that the rates are not fair and should be adjusted higher to the current cost of living now these days. While the typical way to outperform these savings accounts is to just invest in the stock market, not everybody wants to expose themselves to that risk. Some people just want that steady income, or just income in general. I have found some assets that appeal to the investor who wants a little more consistent income via dividends. While these assets do have price action and offer dividends, they're an alternative option for investors to outperform high yield savings accounts and CDs. The first one that we will be talking about is the Strategy Inc. 9% Series A Perpetual Stretch Preferred Stock, ticker STRC. STRC is a short duration high credit yield asset that currently pays 11.5% annual dividends, payable monthly in cash. STRC's dividend rate is adjusted monthly to encourage trading around STRC's $100 par value and help strip away price volatility. This is going to be about as close as you can get for an asset to be pegged to a certain amount. Keep in mind that this is not perfect and does not always trade exactly at $100. STRC's inception was back in July of 2025, where it first opened around $88.60 a share. That stretch from its inception to the beginning of 2026 is pretty volatile, with some stretches of it nearing that $99 to $100 mark and then falling back down. But since the beginning of 2026, STRC has remained relatively consistent and pretty close to their goal of $100 a share, with only one volatile price movement where it went from trading around $99 a share in the beginning of February to a sharp spike down to about $93 a share, but it recovered within a day and since then has been fairly consistent. STRC has a current dividend yield of 11.59%. With its inception being less than a year ago, we have a small sample size to work with when going off the yield and dividend payouts. But since its inception, STRC has paid dividends monthly and they have grown each time all the way up until the previous payment, where it remained at 96 cents for 2 consecutive months. Probably won't be the case where they constantly increase their dividends every month, but if they can stay in the ballpark of around $100 a share and a dividend yield around 11%, this is an excellent alternative option for those who want to pivot away from high yield savings accounts and CDs. The next asset is also managed by Strategy. The Strategy Inc. 10% Series A Perpetual Strife Preferred Stock, ticker STRF, is another asset that looks to offer consistent dividends near a preferred rate. While the previous asset we talked about attempts to stay pegged to about $100 a share, STRF does not. STRF is Strategy's senior most perpetual preferred stock. STRF offers 10% dividends annually, payable quarterly in cash. STRF has governance rights and dividend rate step-up penalties in the event of missed dividend payments. STRF has about a year of price and dividend data, with its inception being back in March of 2025. Its price action is somewhat similar to that of STRC, but it's just not pegged to a certain amount. Since its inception, STRF has had lows of about $86 a share and highs of $122 a share, and since the beginning of 2026, has been trading between $95 a share and $110 a share. It paid out about $10 annually, with its dividends paying out about $2.50 quarterly. This one is more risky compared to STRC since it has more volatile price action, but it does offer a great dividend yield. The common question that I will be asking is whether these yields and prices can hold over time. The last asset I will go over is the Strive Asset Management Equity, ticker SATA. SATA is a preferred equity instrument that currently pays a monthly dividend of 13% annualized to investors. Strive targets a $99 a share to $101 a share trading range for SATA to minimize the volatility of the security. The company currently holds 18 months of cash and reserves for dividend payments and also holds over 13,000 Bitcoin, which, when combined with the reserves, gives the company the ability to cover interest payments for over 19 years. The dividends paid by SATA are classified as return of capital, which means they're tax deferred for U.S. investors. SATA is part of the fast growing sector of income assets called digital credit, where a company offers a liquid instrument designed to trade with minimal volatility while the company underwrites Bitcoin risk. While SATA tries to trade around $99 to $101 a share, it has had trouble doing so since its inception. SATA's inception is in November of 2025, where it began trading around $88 a share. Since then, it has had lows of around $82 a share and highs of around $101 a share. While its peaks have met its price targets, its valleys have not. This has been pretty volatile since inception, making it similar to STRF. While it does keep its promise of paying out high monthly dividends, the price action might not be suitable for all investors. At the end of the day, all these assets offer high dividend yields that outperform high yield savings accounts and CDs, at the cost of price volatility, of course. STRC is good for investors who don't want their initial investment to fluctuate too much while still getting those monthly dividends. STRF and SATA are good for investors who might be seeking a higher yield respectively and more price volatility for their potential of their initial investments to appreciate or, of course, depreciate. Please remember that this is not financial advice. I will be transparent when I discuss different types of investments. Out of all three of the assets I went over, the one I would put money into is going to be STRC, just because it has the best track record of relative price stability. I think for those who want high income now and aren't afraid of their initial investment depreciating in value, these assets are a good alternative option to help you outperform high yield savings accounts and CDs. Thank you for watching. I appreciate your time and I hope you enjoyed the information and data I provided. Okay, bye.